We're starting on the big picture, Teresa, because you have indicated that right now, all these geopolitical risks, and some so unexpected like Chile, are the biggest risk to the investment outlook. Why?
Well, I think a lot of the investment community has really been focused on the U.S.-China trade dispute. And the reality is that that will, ebb and flow depending on the sentiment, especially at the sentiment of the U.S. president. However, what we're actually seeing that might be a common thread around the world in terms of the most recent social unrest is the fact that governments are, in fact, having increasing difficulty putting through any type of austerity measures. So, if you take a case in point in the case of Santiago, Chile, these are the worst protests that they've seen, for decades. And we're talking about a 4% increase in the fares of public transportation. And what we're seeing is that people, I think, are really quite fed up with the income inequality and the inability of the lower and the middle income class to really keep up their standard of living. And as the government tries to put through any type of taking away of subsidies or austerity, they're going to continue to hit these types of social problems. So that's one case in point. We also have problems already in Ecuador, which is a very typical emerging market country. And I think that these types of risks will actually be here to stay, and it's much more structural that cannot be addressed with the potential lifting of the current U.S.-China trade tension.
Very good point. There's a lot of things that are going to persist even as that deal gets more on track. The IMF last week, the standard line was, central banks can help with easing, and we hope they continue, but now we need fiscal stimulus. Who around the world is not saying we need fiscal stimulus? When you put a new tax on subway fares, or when you put tax on WhatsApp messages in Lebanon, you're just piling on the money. The cost. You're not giving the kind of stimulus to these people that they need. Is this what it takes now? Do people need to protest to get the government to step in?
I think increasingly governments are aware of the fact that there are limitations to monetary policy. And increasingly, there is a lot more of the pointing finger and throwing the ball back in the court of the finance ministries and what can be done on the fiscal side. When we look around the globe, we actually do see countries with room to do more fiscal easing. Case in point, Germany, and even places like Korea. We think that there is actually room for further fiscal spending. But in other places, there's a lot more constraints on the fiscal side. And in those countries, it's going to be much harder, to really push against the string. And those places, include, I think, most of the emerging market countries.
Well, it's also a case of perhaps, diminishing returns as well as rising risks, right? You mentioned South Korea. We know that there's a problem with household debt, as is here in Australia as well, where we're looking at the RBA continue to ease as well. There's greater and greater conversations about the boundaries of monetary policy and what unconventional policy could be in the future. Is that kind of the new frontier, if you will, that we're getting into in the next year or two to come?
I think yes and no. I think specifically in the case of Korea, the Korean government has really studied what has happened in Japan. And I think they've decided that they don't want to go there. The negative spillover effects of the unconventional monetary policy in Japan has really led to, intermediation, the whole channel of banks, being able to lend money, really breaking down. And as a result, we think that there's still room for Korea to cut rates on the one hand, but they're going to also be, on the other hand, be more open with fiscal stimulus. Let me just maybe follow on that point and unpack that. The life insurance companies, for example, in Korea, will have to adopt a new IFRS. So these are new international accounting standards, which will actually force them to mark their liabilities up in duration. So what that means is there's actually going to be greater demand for government paper, especially long-dated government paper. And that actually bodes well for a government that is actually looking to spend more. And to do that, they have to basically, borrow more in the markets. So both on the supply and demand side, on the bond part, it could actually be, quite an opportune time for the South Korean government to step on the gas pedal and actually complement existing monetary policy.